America struck and immediately offered to sit down at the negotiating table. The new U.S. tariffs on Chinese goods reached an unprecedented 245%. Electric vehicle batteries, solar panels, and telecommunications equipment were among the items hit. But no sooner had the blow been delivered than Washington extended a diplomatic hand to Beijing. What is this? Negotiation theater? A bluff? Or a desperate attempt to avoid economic catastrophe? On April 14, 2025, the administration of Donald Trump announced a sweeping increase in tariffs on nearly $150 billion worth of Chinese imports. Tariffs on key items, from batteries to telecom equipment, rose to levels never seen before. Simultaneously, the U.S. Trade Representative issued a statement. Washington is ready for serious dialogue with Beijing. Bloomberg called it a diplomatic paradox disguised as strategy. But can negotiations be taken seriously when the other side is wielding an economic sledgehammer? The IMF suggests that Washington hopes increased pressure will lead to concessions, but China did not respond. At all. No gesture, no comment, only silence. Beijing's silence, analysts believe, is not a sign of weakness but a new tool of influence. China refused to play by American rules and completely ignored the invitation to negotiations. Markets, which initially reacted positively to the news of potential talks, immediately crashed when the details of the new tariffs became known. This was not a response, it was a cold, calculated refusal to participate in the show. Inside the United States, the economic blow is already being felt. The state of California, which accounts for 11% of the country's GDP and over $166 billion in imports from China, has found itself at the epicenter. The state's lieutenant governor openly accused the White House of destroying supply chains and fueling inflation. 47 major business groups, from Silicon Valley to the ports of Long Beach, submitted an urgent petition requesting tariff exemptions. According to a Morgan Stanley study, California risks losing more than 142,000 jobs if the tariffs remain in place through the end of the third quarter. At risk are high-tech sectors, logistics, and retail. Even traditionally Republican Texas has begun expressing concern, as its economy relies heavily on the export of equipment and agricultural products to China. On a macroeconomic level, the consequences have not taken long to appear. According to the Bureau of Labor Statistics, inflation in the United States jumped again in April 2025, reaching 6.2% year over year. The price increases are fueled directly by the tariffs. Meanwhile, GDP in the first quarter plummeted to 1.1% compared to 2.8% the previous quarter. The Federal Reserve has found itself trapped, raising interest rates, risks, crushing economic growth, while lowering them could further weaken the dollar, which has already dropped by 4.6% since February. The financial world is sending a clear signal. Confidence in the dollar has been shaken. J.P. Morgan reports that the central banks of India, Brazil, and Saudi Arabia have offloaded American bonds worth $43.7 billion in just 6 weeks. This is not merely a shift in capital, it is an exodus. China's reaction was concise but precise. On April 15th, the Ministry of Foreign Affairs of the People's Republic of China stated, "There will be no negotiations under pressure. No clarifications, no briefings, no explanations. Silence as a strategic tool." According to Professor Shun Yi of Tsinghua University, this represents a principled refusal to play along with America's cartoon. China will not aid Washington in maintaining the illusion of a diplomatic process. Instead, it is executing a deliberate reorientation. The climax came on April 16th. China imposed retaliatory tariffs of 125% on American airplanes, microchips, and construction machinery. This nullifies approximately $17 billion of expected U.S. exports. The heaviest blow was the nearly 12% drop in Boeing's shares after Beijing canceled orders for more than 70 aircraft. On the same day, Airbus signed a new strategic agreement with China. This is no longer a response, it is a replacement. Meanwhile, the People's Bank of China delivered another blow. The yuan fell to 7.98 per dollar, the lowest level since the end of 2023. But this is not a crisis, it is a calculated move. By setting the exchange rate below market expectations, Beijing is stimulating exports to Europe and Southeast Asia. Within 48 hours, order volumes rose by 3.2%. The United States imposes tariffs. China lowers prices. Economic judo instead of frontal assault. The data for the first quarter of 2025 speak for themselves. China's exports to the United States declined by 27.4% year-over-year. In contrast, shipments to ASEAN countries rose by 19.8% and to the European Union by 13.2%. In April, China and the EU signed a 25-year trade pact. It includes the supply of green technologies, yuan-denominated contracts, and a dispute resolution mechanism that bypasses the WTO. This is not a tactical move, it is a systemic restructuring. But China is not merely rerouting supply chains. It is reshaping the architecture of global finance. In the first quarter, its trade surplus amounted to $273.4 billion. These funds are not going into reserves, but into targeted development. $62 billion into the Semiconductor Fund and $42 billion into subsidies for electric vehicles in rural areas. 14 new clearing banks have been established in Africa and Eurasia, from Nairobi to Frankfurt. China is not borrowing, it is investing from its surplus. This is a new model, growth without debt. The financial fragmentation of the world is becoming a reality. Already, 61 countries conduct more than 15% of their foreign trade in currencies other than the dollar. The yuan has reached a record share of 5.4% in the SWIFT system. The dollar's share has fallen below 39% for the first time in a decade. Brazil pays for oil from Angola in yuan. India is implementing rupee-based settlements with Russia and the United Arab Emirates. Even U.S. allies like Germany and South Korea are diversifying their currency reserves. In April, the World Bank published a key statement. The global economy is entering an era of financial bifurcation. Trade and capital flows are following currencies more than flags. The United States still controls the global financial system, but China's strategy is not aimed at domination. It is aimed at isolation from risk. And the faster it is implemented, the less chance there is of reversing it. If China, without firing a single shot, managed to reconfigure its exports, undermine U.S. tariffs, and mobilize hundreds of billions for industrialization, then the question is not whether the trade war has begun. It is whether this will be the last one for the United States as the dominant player on the global stage. And if this was just the defense, what will the offensive look like?